Okay, the Fed claims it will allow inflation to run above 2%. I'm using the air quotes here because if you know our view on the Fed, you know that central banks do not actually control inflation. Yes, the Fed can take various actions, but social mood governs whether people accept or reject those actions. In fact, the effects of that 2 trillion stimulus in the second quarter, the effects are fading already, and we can see this deterioration in lots of things like consumer spending, right? Back in May, spending had shot up nearly 9% over April. By June, the increase had dropped to 6%, and by July, it's down to 2%. Consumer spending is following the trend in stocks, and we can see that on the bottom chart here. Bottom graph is consumer spending totals. Just notice how this measure tracks the trend in the NERS composite. Our view is that the Fed does not control how and when Americans consume. Measures like this depend on the mood of consumers, and that mood is indicated by widely traded stocks and stock indexes. So I know our view goes against conventional wisdom, but there's other places to see it. Take credit card usage, for instance. This should be a really good indicator to watch in the months ahead. This chart shows year-over-year changes in US credit card spending. So this is a 4-week moving average. It's tracking the Dow very closely. Credit card usage tanked in March, obviously bottomed in April, right? Following the low in the Dow, rebounded with stocks, and it has drifted since June. So our view is that a rise in the stock market coincides with a rise in consumer sentiment, which coincides with a rise in spending and credit card usage. If stocks have made their highs, these metrics will all begin to fall again, and there really is not anything the Fed will be able to do about it. Now, another really interesting chart that illustrates what the central bank is up against, right? The Fed is not merely fighting a, short-term pandemic-induced drop-off in demand. The Fed is fighting what we think is a growing new mood of financial conservatism, right? It's been subtly building, and the pandemic has brought it on more quickly. Notice this chart of revolving consumer credit. That's the top graph. This metric is dominated by credit card debt. The bottom graph is just the 1-year rate of change. The rate of change has gradually slowed for decades, finally slipped below zero in January of 2009. That was 2 months before the end of the last bear market. The most recent peak rate of change, it was actually back in early 2017, and that was easily the lowest peak growth rate in the last 40 years. We've now gone below zero again, which appears to be foreshadowing this new mood where consumers essentially shift their priorities away from consumption and toward savings. So these are some of the metrics to watch in the months ahead, especially as we move, into the fourth quarter and we see what happens with holiday spending. Again, once stocks turn, the economy is going to follow as it always does. And contrary to popular opinion, the Fed will be unable to reverse it.